Okay, so you want to own a dollar store? It feels like the most recession proof, idiot proof business in America. No skill required, no glamour required, just a building full of cheap plastic and a cash register. And the chains prove the model works. Dollar General alone runs more than 19,000 stores in the United States. Add in Dollar Tree and Family Dollar, and the three biggest dollar store banners combine for over 34,000 locations, more storefronts than McDonald's, Starbucks, Target, and Walmart combined. So you go looking for a way in, a franchise application, a territory map, a startup packet, the same on-ramp that got a few 100,000 people into a Subway or a Chick-fil-A. Here's the part that changes everything. You can't buy one. Not a Dollar General, not a Dollar Tree, not a Family Dollar. Every single one of those 34,000 stores is corporate owned. There is no franchise fee to pay, no territory to apply for, no application to fill out, because the application doesn't exist. The biggest, most replicated retail format in the country is also one of the most closed. So what are you actually buying when someone sells you a dollar store? That's the real question, and the answer runs through real estate, private equity, and one of the largest food safety fines in American history. Start with the three names everyone means when they say dollar store. Dollar General, Dollar Tree, Family Dollar, which Dollar Tree owns. All three are public companies. All three build, staff, and operate every one of their stores directly, with employees on a corporate payroll, not owner-operators who signed a franchise agreement. There is no Dollar General franchise disclosure document because there is no Dollar General franchise. That's a deliberate structural choice, not an oversight. A franchise model spreads capital cost onto thousands of small operators in exchange for giving up some quality control. Dollar General and Dollar Tree run on the opposite bet. Keep every store, every price tag, and every supply contract under one roof because the entire model depends on identical execution at extreme volume. A franchisee who wants to charge $4 for a $5 item or who skips a vendor rebate program breaks the math for the whole chain. So corporate keeps the wheel. What you can actually buy into is a tier below that, small independent operations using the words dollar store generically, not as a brand. The most visible of these is a company called Dollar Store Services, which isn't a franchise in the legal sense at all. It's a turnkey consulting and build out service. They'll design your store, ship you the fixtures, plug you into a supplier network, and send you home to compete against a Dollar General that might be built 400 yards away. No brand name transfers with the deal. No national ad campaign backs you up. No 34,000 store buying power negotiates your unit cost. You get the format. You do not get the moat. Here's what that tier actually costs. Dollar Store Services charges no franchise fee and no royalty. That's the headline, and it's real. But no franchise fee is not the same as cheap. Their own published range for a full turnkey build-out runs from $76,900 to $366,900, depending on store size, and they ask for a minimum of $40,000 in liquid cash before they'll even start the paperwork. A typical bare-bones location lands around $87,900 once you count real estate costs, fixtures, signage, licenses, uniforms, and insurance on top of the merchandise itself. Compare that to what it costs to build the store you're actually competing against. A new Dollar General location, built to the chain's own specification for a commercial landlord, runs well past $1 million in construction and site cost before a single box of merchandise arrives, money that isn't coming from a franchisee at all, because there is no franchisee. It's coming from a developer who will lease the finished building back to Dollar General for 15 years. So the entry ticket you can actually buy, under $370,000, no franchise fee, isn't a smaller version of the giant next door. It's a completely different, much riskier business wearing the same sign. Here's the part nobody selling you a dollar store wants to lead with. The merchandise isn't the profit engine. It's barely a profit engine at all. Dollar General's own operating margin fell to 3.9% in the summer of 2023, down from 7.5% the year before for the industry leader. At 19,000 stores of scale, ringing up a dollar's worth of goods nets less than 4 cents of operating profit. The real money in dollar stores sits one level up, in the real estate underneath them. Over the last decade, dollar store buildings became one of the most sought-after categories in the entire net lease investment market, the same asset class as a Walgreens or a McDonald's ground lease. New Dollar General locations typically sign 15-year triple net leases with 10% rent increases built in every 5 years, at cap rates around 4.75 to 5.5%. To an investor, that's not a retail bet. That's a bond with a cap rate instead of a coupon, and Dollar General's cash register as the guarantor. That's the actual business. The stores exist to generate a rent check reliable enough for a real estate investment trust to buy the ground under it and sleep soundly for 15 years. The 3.9% margin isn't a bug in the model, it's the model run as tight as legally possible because the equity value was never supposed to come from selling $2 dish soap. It was supposed to come from the building. In January of 2015, Dollar Tree and Dollar General went into a bidding war over Family Dollar, a chain that was struggling to compete with both of them. Dollar Tree won, paying $8.5 billion in cash and stock to bring Family Dollar's roughly 8,000 stores under its roof. It never integrated cleanly. Family Dollar kept running on its own distribution network, its own real estate footprint, and its own store standards, and by 2020, that network was breaking down in a way that would become a federal criminal case. Family Dollar's distribution center in West Memphis, Arkansas started generating pest complaints from stores that year. By January 2021, employees inside the company already knew products shipped from that warehouse were compromised. It took until January 2022, a full year later, for an FDA inspection team to walk into the facility and find live rodents, dead and decaying rodents, rodent feces, and urine throughout the building, and evidence of nesting in the stored product itself. Fumigation crews went on to exterminate 1,270 rodents. Family Dollar issued a recall covering every drug, cosmetic, and food product shipped since January 2021 to the 404 stores that warehouse served. In February of 2024, Family Dollar pleaded guilty in federal court to holding consumer products under insanitary conditions and agreed to pay $41,675,000 in fines and forfeiture, the largest monetary penalty ever handed down in a U.S. food safety case. That same year, Dollar Tree announced it was closing roughly 1,000 stores across both banners, including about 600 Family Dollar locations in the first half of 2024 alone, with hundreds more to follow. By 2025, Dollar Tree gave up on the acquisition entirely and sold Family Dollar to a pair of private equity firms for $1 billion, roughly 12 cents on every dollar it had paid a decade earlier. Run the independent operator's numbers both ways. Picture someone who put up roughly $150,000 for a turnkey dollar store build-out inside the $76,000 to $367,000 range this tier actually costs. In a good year, sourcing stays cheap. Roughly 40% of a typical dollar store's inventory arrives from Chinese manufacturers at the same landed cost it always has. Gross margin holds in the low to mid 30% range that this format runs on, and the store clears enough over its lease, payroll, and utilities to pay the owner a real, if modest, income on top of the original investment. In a bad year, one input changes everything, because the entire format is built around a fixed price point the customer expects. $1, $1.25, $5, a number the operator does not get to renegotiate every time costs move. When a new round of tariffs hit Chinese imports, Dollar Tree, a company with $19 billion in annual revenue and a corporate hedging desk, told investors a single 10% tariff increase could cost it $15 to $20 million a month, and warned publicly that a bigger round could cut a quarter's profit in half, even after months of mitigation work. An independent operator with none of that scale, none of that supplier leverage, and none of that hedging desk absorbs the same proportional hit directly against a margin that was already in the low 30s, while the fixed price shelf tag stays exactly where it was, because changing it breaks the one thing the format sells. Same building, same lease, same fixed price point on every shelf. The gap between those 2 years isn't decided by how hard the owner works, it's decided in Washington and Beijing, months before the owner ever sees the invoice. A dollar store was never really selling you $1's worth of anything. It's selling the landlord a 15-year bond disguised as a lease. It's selling the supplier a guaranteed shelf. And it's selling you, the person who wired in $70, $80, $300,000 for the build out, the one part of the transaction with no guarantee attached at all. The illusion that the sign out front means you own what's inside it. Every party in that chain gets paid before you do. The REIT collects its rent, whether the shelves are full or empty. The supplier collects its margin, whether the store has a good quarter or a bad one. Corporate headquarters, 34,000 stores deep, never once has to sign your lease or read your tariff notice. You're the only name on the deal with nothing standing behind it but the register. So the honest version of the pitch isn't own a dollar store, it's rent the risk on someone else's real estate at someone else's price point and hope the year works out in your favor. Everyone else in the chain already made sure it works out in theirs.